Welcome to Metal Market News. I'm Professor Harry, and as always I'm here with you as an independent analyst bringing you a clear, data-driven perspective on what's really happening inside the precious metals market. And right now what we are witnessing is not just a simple pullback but a highly complex interaction between technical structures, macroeconomic pressure, and institutional behavior. And when we begin with the opening argument around silver potentially retracing toward the $38 level. Based on Fibonacci projections, it immediately highlights how technical frameworks are currently dominating short-term expectations, because Fibonacci retracements and extensions are not just random tools but widely followed reference points used by institutional traders, and when a large portion of the market is watching the same levels, those levels tend to become self-fulfilling in the short term. And I agree with the analysts' view that the $38 level represents a significant historical launch zone where price previously broke out aggressively, because markets often revisit these zones to test the strength of prior demand, but where I would expand on this analysis is by emphasizing that such moves are rarely purely technical, because the alignment between technical targets and macro catalysts is what ultimately determines whether those levels are reached, and in this case, the discussion around rising interest rates, a stronger dollar, and central bank gold selling creates a macro backdrop that could indeed justify a deeper correction, and when we look at the described move from 5,400 to 4,400 in gold, it becomes clear that this was not a normal retracement but rather a rapid repricing event driven by a convergence of factors, and this is what the analyst refers to as a perfect storm. And I agree with that characterization because when yields rise sharply within a short period, it directly increases the opportunity cost of holding non-yielding assets like gold, which leads to systematic selling by both discretionary and algorithmic participants, and when you combine that with a strengthening dollar, which historically has an inverse relationship with gold, the pressure intensifies further, and then when you add forced selling from central banks such as Turkey, which reportedly liquidated significant gold reserves, you create an oversupply shock at a time when the market is already technically vulnerable, and this combination explains the move rather than suggesting any fundamental collapse in gold's long-term value, and I would strongly reinforce this point because many investors misinterpret sharp declines as a change in fundamentals, when in reality they are often the result of temporary imbalances between supply and liquidity, and this is where I slightly differ in tone from the original analyst, because while the possibility of gold falling to 3,400 cannot be dismissed under extreme conditions, I view such a scenario as contingent rather than probable, meaning it would require of the same pressures, including further yield increases, continued dollar strength, and additional central bank selling, all occurring simultaneously, which is a high bar to maintain over time, and therefore while the downside risk exists, it should be framed within a probability spectrum rather than as a base case. And this distinction is critical for investors because it prevents emotional decision-making during periods of volatility. And ultimately what we are seeing in this phase is a market transitioning from euphoria to recalibration, where excess optimism is being unwound and price is searching for a new equilibrium that reflects both technical and macro realities. As we move deeper into the technical structure described in the script, the focus on price action patterns such as large bearish candles followed by periods of consolidation, often referred to as inside days, provides valuable insight into market psychology. Because these formations are not just visual patterns but reflections of how participants are positioning themselves after a major move, and when a large red bar is followed by a series of smaller upward moves within its range, it typically indicates that buyers are attempting to regain control but lack conviction, which is why such patterns are often interpreted as bearish continuation signals. And I agree with this interpretation because it aligns with the concept of supply overhang, where sellers remain dominant and use rallies as opportunities to exit positions, and when the analyst explains that a rejection near the top of that range often leads to a retest of the lows, it highlights the importance of understanding how momentum shifts occur in rather than in a single move, and this is where Fibonacci retracements become particularly useful, because they provide a structured way to measure these and anticipate potential reversal points, and the discussion around the 38%, 50%, and 61.8% retracement levels is especially relevant because these are the zones where market participants typically reassess their positions, and I agree that a rejection at the 38% or 50% level often signals continued weakness, while a move toward the 61.8% level suggests a deeper correction may be, but I would add that these levels should not be viewed in isolation, because their significance increases they align with other factors such as previous support and resistance zones, volume clusters, and macro developments, and when we consider the projection that a move to the 50% retracement could lead to a further decline toward 3,400, it illustrates how technical analysis can provide a roadmap for potential outcomes, but it is important to remember that these are scenarios, not certainties, and this is where I believe the original analysis could be slightly misinterpreted by less experienced viewers, because presenting specific price targets without emphasizing the conditional nature of those projections can create a false sense of inevitability, and in reality, markets are probabilistic systems where multiple outcomes coexist until one is confirmed by price action, and when we zoom out to consider the broader context of the previous euphoric phase described, where rapid price increases attracted a surge of new participants, it becomes clear that the current correction is also a process of redistributing positions from weaker hands to stronger ones. And this is a recurring pattern in all major markets, where periods of extreme optimism are followed by sharp corrections that test the conviction of participants, and I strongly agree with the idea that markets have a way of applying pain to the largest number of participants, because this is how they maintain efficiency and prevent overcrowding in one direction, and therefore the current volatility should not be viewed as an anomaly but as a natural part of the cycle, and when understood correctly, it can provide valuable opportunities rather than just risk. Now when we shift our attention specifically to silver, the narrative becomes more nuanced because silver occupies a unique position as both a monetary metal and an industrial commodity, and this dual role creates a complex set of drivers that can sometimes pull price in different directions, and the analysis presented highlights this complexity by acknowledging both the strong fundamental case for silver, driven by persistent supply deficits and industrial demand, and the emerging signs of short-term stabilization or even easing in certain areas, and I agree with the assessment that the long-term fundamentals for silver remain robust, particularly when we consider the cumulative supply deficits approaching nearly 1 billion ounces over recent years, because such deficits are not easily resolved and tend to create structural tightness in the market, and the drawdown in above-ground inventories, especially in key markets like Shanghai, further reinforces this point because that physical supply is being consumed faster than it is being replenished, and this is a critical factor that differentiates silver from many other commodities, where supply can be adjusted more quickly in response to price changes, and however, the analysis also points out that some of this tightness may be easing, as indicated by declining lease rates and the disappearance of backwardation in Western markets. And this is where I would introduce a more balanced perspective, because while these indicators do suggest a normalization of short-term conditions, they do not necessarily negate the broader structural deficit, and in my view, what we are seeing is a temporary relaxation within a longer-term tightening trend, rather than a complete reversal. And this distinction is important because it helps reconcile the apparent contradiction between strong fundamentals and stable or even slightly weaker prices, and when we factor in geopolitical elements such as disruptions to energy supply and their potential impact on industrial demand, particularly in major consuming countries like China, it adds another layer of uncertainty, because if economic activity slows, demand for silver in industrial applications could decline in the short term, even if the long-term trajectory remains positive. And I agree with the analysts' caution in this regard, because markets are forward-looking and will adjust prices based on expectations of future demand, not just current conditions, and therefore any of slowing growth can have an outsized impact on price, even if the underlying fundamentals remain supportive, and this is why silver often experiences higher volatility compared to gold, because it is influenced by both monetary and industrial cycles, and ultimately, the key takeaway from this section is that while silver's long-term outlook remains constructive, its short-term behavior is likely to be shaped by a complex interplay of factors that require careful analysis rather than simple conclusions. Continuing further into the structural and behavioral dynamics of the market, the discussion around central bank activity and the strategic implications of their actions introduces a critical that is often misunderstood by retail investors, because there is a widespread belief that central bank buying automatically guarantees higher prices, but the reality is far more complex. And I strongly agree with the analyst's point that central banks, like any large market participants, have an incentive to optimize their strategies, which may include allowing or even contributing to periods of price weakness in order to accumulate assets at more favorable levels, and this does not imply manipulation in a simplistic sense, but rather reflects the strategic behavior of large who operate with long time horizons and significant resources. And when we consider the idea that central banks might prefer lower prices to increase their holdings, it challenges the common narrative that their buying activity will continuously push prices higher without interruption, and this is where I would expand the analysis by noting that markets often move in cycles of accumulation and distribution, where periods of weakness provide opportunities for strong hands to build positions, and periods of strength allow them to distribute or rebalance, and this cyclical behavior is evident across all asset classes, including precious metals, and when we connect this to the earlier discussion of euphoria and subsequent correction, it becomes clear that the current phase may represent a transition from a distribution phase back into a new accumulation phase, particularly if prices move lower and attract long-term buyers, and this perspective aligns with the idea that a significant correction, while painful in the short term, can create opportunities for those with a longer investment horizon, and I agree with the sentiment that a deeper pullback could be viewed as a buying opportunity, but I would emphasize that timing such opportunities requires patience and discipline, because markets rarely provide clear entry points and often test support levels multiple times before establishing a sustained trend, and when we look at the specific price levels mentioned for silver, including the support around 70 and the potential downside toward the mid-50s near the 200-day moving average, it highlights the importance of identifying where buying interest is likely to emerge, and I agree that these levels represent meaningful support zones, particularly when they align with historical price behavior and key technical indicators, but I would also caution that support levels are not guarantees, and they can be broken under sufficient pressure, which is why risk management remains essential even in fundamentally strong markets, and ultimately, the interplay between central bank behavior, technical, and market psychology creates a dynamic environment where opportunities and risks coexist, and the ability to navigate this environment depends on a comprehensive understanding of all these factors rather than reliance on any single narrative. As we bring this entire analysis together into a broader strategic perspective, it becomes clear that the current state of the gold and silver markets is defined by a tension between short-term pressures and long-term fundamentals, and the recent correction, while significant, does not necessarily invalidate the bullish thesis that has been built on factors such as monetary instability, rising global debt, and the increasing role of precious metals in reserve strategies, and I strongly agree with the conclusion that this environment requires a nuanced interpretation, because simplistic narratives, whether bullish or bearish, fail to capture the complexity of the forces at play, and when we consider the potential scenarios outlined, including the possibility of further downside if interest rates continue to rise and the dollar strengthens, it highlights the importance of monitoring macroeconomic indicators closely, because these variables have a direct and immediate impact on precious metals prices, and at the same time, the structural factors supporting gold and silver, including supply constraints, industrial demand, and central bank accumulation, provide a foundation that limits the extent of any prolonged downturn, and this creates a market environment where volatility is likely to remain elevated, but within a broader framework that still favors higher prices over the long term, and I would emphasize that the key challenge for investors in such an environment is not identifying the long-term trend, but navigating the short-term fluctuations without losing sight of that trend, and this requires a disciplined approach that balances conviction with flexibility, allowing for adjustments as new information becomes available. And when we revisit the core question in the script regarding whether continued central bank selling and rising rates could force gold into a prolonged revaluation phase, my view is that while such a scenario is possible, it would likely be temporary unless accompanied by a fundamental shift in the global monetary system, which at this stage appears unlikely. And therefore the more probable outcome is a continuation of the broader trend after a period of consolidation and adjustment, and in the case of silver, the combination of structural deficits and industrial demand suggests that any sustained weakness would eventually be met with increased buying interest, particularly at lower price levels. And this reinforces the idea that corrections in such markets should be viewed as part of the cycle rather than the end of it, and ultimately, the most important takeaway from this entire discussion is that markets are driven by a combination of fundamentals, technicals, and psychology, and understanding how these elements interact is essential for making informed decisions, and as always, the goal is not to predict every move, but to position oneself in alignment with the most probable outcomes while remaining prepared for alternative scenarios.